Do you know what you'll spend in retirement? Well, in this video, I'll make the case that you can easily find out, but it's probably not in the way you've been told. If you don't know me, my name's George Agan. I'm a chartered financial planner, a fellow of the Personal Finance Society. I've helped thousands of people retire without worry. And I've created quite a few videos where I've referenced the expenditure amounts in retirement, like many other creators in the space, and I've referenced the retirement living standards. These are specific figures which are updated each year by the Pension and Lifetime Association. I'll put the figures on the screen now. They do vary if you're one person or a couple, because generally two people have lower bills per person because they're splitting the main bills. It also categorizes these into minimum, moderate and comfortable ranges, providing an explanation on the context of what someone should expect as far as lifestyle if they, for example, were at a moderate level, such as a 3-year-old small car replaced every 7 years or a fortnight all-inclusive holiday in the Med. These figures, I personally think, are very good. They're just a stake in the ground on what is one of the most variable and individual things out there, which is our lifestyle. I mean, to defend using these things, you can't really win whatever you use. There'll always be someone who finds it unrealistic or jarring, whether that's too much or too little. I often receive some pushback in my comments saying this exact thing. The retirement living standards just scare people, that they aren't really helpful. So let's talk about some context about what they are. So if you use a 4% rule as your retirement pot guide, as in what you need in retirement, basically this will give you an idea of a 31,300 moderate lifestyle. You need a pot of 782,500, or for the 43,100 comfortable retirement, you need a pot of over $1 million. Now, these figures are rough and a bit nonsense because of the state pensions, but the point is you can easily see how someone will get very disheartened about what they need to achieve. And to quote a paper from the IFS, they talk about the retirement living standards and they say they give an annual income amount of expenditure that achieves a standard of living, but crucially, this amount, the figures, don't assume costs on housing, care, or tax. That means that for these living standards, the pre-tax income will probably be much higher. A household who might have mortgage repayment or rental costs will be much higher even to reach this benchmark, or if they want to put aside some money for care. But there is an even bigger, more insidious problem with all of this. And there's a great stat in this paper from the IFS which says many working families currently have income below the equivalent PLSA minimum living standards. 32% of working couples and 44% of working single people have an income below these minimum retirement income targets. So put very simply, it's all well and good having these retirement living standards, but how on earth are people supposed to expect these standards in retirement when over 1 in 3 people don't have these standards living now while working? I mean, aren't we just setting them up to fail with these targets? But what if there was a better way? A way that was more intuitive, aligned close to what I've seen as an advisor in thousands of meetings? So let's dive into this, looking at a research paper from the IFS called Adequacy of Retirement Incomes, New Evidence from Private Sector Employees. And this paper provides an overview about where we are in relation to UK as far as a pension system and provides context on whether most people are going to be on track for an adequate retirement income. It talks at the start about the mixed fortunes of the UK pension system, saying there's some good and bad stuff that's happened. Effectively, one of the big things which is a positive side is that the state pension now accounts for a bigger share of a retiree's income compared to 2004 due to rises, the triple lock. And this is actually going to reduce an individual's saving requirement compared to how it was, for example, in 2004. There is a big problem, though, is that there have been other changes, like changes to the economic environment, namely longer life expectancy, which is a great thing, lower earnings growth, which is not so much, and lower returns on savings. And all those things combined have collectively offset the positive improvements given by a higher state pension. The paper references that 4 out of 10 are likely to be undersaving for retirement. And the below shows you a stat of working households with an income net of housing costs, which are currently below the minimum and moderate PLSA living standards. So just to reiterate, these are people who during their working lives are below the current PLSA standards, with the dark green line being behind moderate and the light green line being below minimum. If you have a look at them both, it's like everyone, it's about 75% or more of couples. So I'm starting to really get these critical comments saying the figures are unrealistic. I mean, come on, there's got to be another way. Okay, so let's now talk about a replacement rate approach. The replacement rate approach considers retirement income adequate if it maintains a certain proportion of an individual's pre-retirement income. Basically, you spend in retirement a proportion of what you spend in your working life. If you're a big spender during your working life, you don't expect to turn off the taps and become a penny pincher. To the same extent, if you've never been a big spender, we don't expect that you're suddenly now going to need some arbitrarily big figure like the retirement living standards might produce. The logic being is that if you spent 30 years of your working life not spending much, and I can kind of tell you as a planner, people don't act like spreadsheets. Some of my conversations with clients around retirement have been, you've been really careful to build up a position of financial freedom, and this is a nice problem to have. But if we don't change your spending habits, you could become one of the richest people in the graveyard. And I personally see it as part of my core role as a financial planner to walk that line between overspending and underspending. So how do we know how much of our working income we need to replace via this replacement rate? Well, the paper does reference some evidence, looking at some empirical studies from the UK, and they found that an average net replacement rate in the UK was around 80%, but it's going to be a much higher rate for people with lower incomes and a lower percentage for people with higher incomes. Very quick plug if that's okay. I've recently revamped my retirement sequence email list. So if you want to get access to a download of 5 pension tax mistakes to avoid from me, which I will need to update in relation to the inheritance tax side, and I will do, alongside tips, strategies that I'm using with clients to make sure that they save tax as much as possible and plan for retirement effectively, do sign up. You'll also get invites to workshops I run on my clients on big changes like inheritance tax planning changes, pension death benefits, pension tax planning. And if that's not enticing enough, I'm actually also designing a cash flow model via Excel, which I'll be giving away free to subscribers. It's not done yet, by the way, but it will be out in the next few months. So it's a great place to be if you want to retire without worry. And of course, you can always unsubscribe at any time if it's not valuable to you. And just to kind of translate this to sort of normal person speak, it's saying, okay, well, if 80% of what you were spending while working is a good guide, you need to bear in mind, if you don't already earn much, you're probably going to need an 80% or maybe even a higher replacement rate in retirement. And this makes intuitive sense. If you earn 15 grand a year now, that's not a particularly high salary. So you'll probably need to replace most, if not all, of that income in retirement. Just because of inflation and the cost of living, there are only so many costs we can cut without it being really painful. Yes, you can go from luxury to standard to budget, but if you're already at budget, it's hard to cut beyond that. To the same extent, if you earn a lot, then a certain amount of that spending might just be, I'm working, I'm happy to spend a bit more because I know there's money coming in. So you do have some headroom to cut down. This graph in the paper shows this really well, saying that if you earn in 2023 up to 17 grand, you will likely need to try and have an 80% replacement rate in retirement. Yet if you earned over 90%, they believe you can cut that down to almost 50%, to just 45,000. I think this is a really interesting discussion, and it's important to mention that things like this paper, which do have a really important role, because what we're trying to do is define the question of what is adequate as far as retirement income needs. And I know that sounds some sort of vague, impossible to answer question, but actually if we think about it, so much is riding on us as a society getting this question right. What you can't do as a 60-year-old is go back and save as a 30-year-old. And there are immense pressures already on trying to ask people to save more. Most individuals are already stretched by the cost of living, stagnant wages, getting on the housing ladder, increased longevity. So what underpins so much government policy is trying to make a good assessment of the biggest question of all: what is enough? And I think this is a useful conversation starter. As an advisor, I just want to underscore that these kind of things can only be a conversation starter. There isn't anyone out there who's going to be able to give you some magic figure and it'll be perfect. As a planner and the work I do with my clients, finding out what enough is a really in-depth process. It's incredibly iterative. We literally meet regularly and adjust when the big changes happen, whether those changes were the underlying assumptions, the legislation, or most importantly, the big change is typically your life changes. So all that is just to say, don't feel overwhelmed if you don't have a perfect number. Great financial planning is much of an art as it is a science. It involves the intersection between maths and the really human aspect of personal finances. So maybe if you're watching this as someone who's trying to learn more about their finances and plan for retirement, all I want to say to you is it's really tempting to think there's an answer hidden in the PLSA standards or maybe a replacement rate. But whether it's a generic rule like the 4% rule, these things are actual terrible rules, but decent guidelines, because we've got to start somewhere. We have to also accept that in making things more precise via things like replacement rates or me talking more depth about cash flow modeling, for the general public, it can sometimes make it harder for people to engage with their finances. An advisor I've always been influenced with, it was always saying, as an advisor, you're more judged on the action that you can bring and inspire in your clients than how good your cash flow model is technically. And I want to say fair play to the IFS in this paper for including the quote in the research, which kind of brings this point home. And they say, and this is someone they've clearly asked when putting together the research, he said, "From the moment I looked at replacement rates, my eyes glazed over. Sorry, my issue here, but I'm sure lots of other people would feel the same. I like to have financial information presented to me in its simplest form." This is the thing. So let me bring together the data, the thoughts that inspired it, and add on a bit of sprinkle of my own insight, having advised thousands of people. So here it is. From my experience advising clients, if I was to give you one single phrase which encapsulates how much someone will spend in retirement, what I personally found is people don't change that much. I think that the data also plays this out, which is that if you have a look at retirement spending patterns, it can be quite similar to the type of spending that they were doing prior, with some key exceptions, like they don't pay for a mortgage if they paid the mortgage off and all the rest of it. You are likely going to have the same broad money habits as a person your working life as when you're retired. That doesn't mean you can't change it if it's appropriate, but it's just to say that's probably what you're going to anchor to unless you are prompted to change. So here's how I think you can have a look at gauging what your spending in retirement is. First thing you need to understand is your current spending. This is half the battle. You need to have a proper assessment of this. Don't forget things like presents, haircuts, medical stuff. As a rule of thumb, if you want a really high level, what do you get paid after tax? What are you saving and investing? And then what do you have spare at the end? Kind of the difference between paid minus all those other bits, saving, investing, and spending. That is your expenditure. You do need to minus any large things which are going to drop off. So obviously, if you've got a mortgage, you need to clear that. If you need to clear that from your expenditure need if that's going to go. But you do need to add on any quality of life improvements that you itemized. So if you've said, I want to travel more, I want to do some bucket list stuff, you do need to obviously cost that in to make sure that's considered. And then finally, make sure we've considered some headroom in everything for affordability of the unexpected. Think back to the last 20 years, whether it was your house, your family, or yourself. Stuff came up that you didn't think about, didn't it? So let's make sure in the plan that there's headroom for that. This should produce a reasonable guide of a figure. Now you can check that against the replacement rate data I've given you and see if it feels right. So see if it feels intuitive. Maybe even have a look at the retirement living standards and see how it compares to that. Why don't you let me know in the comments? Does that feel more intuitive to you in a replacement rate? Well, you might have gone, that's interesting, but I'd still like to know how much my pension pot will give me as far as income. Well, thankfully, I did a video going over pots at various sizes and telling you broadly how much income we'd expect it to produce. So why don't you give it a watch here? Thanks for watching.